Have you ever heard the phrase, the Fed has painted itself into a corner? What does that really mean? How limited are they in terms of raising interest rates and reducing their balance sheet? For years, we have heard Fed minutes where the goal was clearly to return interest rates to their, quote, normal levels. And yet, here we are on the verge of another rate reduction. Furthermore, the quantitative tightening that the Fed was engaging in 2017 has come to a close, and it looks like it may be the case that it never returns again. Today, we're joined by one of our highest rated guests on the program. We're going to talk about a lot of things, high-level economics when it comes to the global capital markets, and even his suggestion in terms of going forward, which is pretty fascinating. We're going to talk about what changes have taken place in the global economy since our guest's last appearance at the end of 2018. What is the current state of the global economy, particularly as it relates to the bond yields of other countries and what countries are near recession, what the implications could be to the U.S. markets. Also, do we need mania to ensure there is some sort of significant correction? And if so, where is that mania in the U.S. markets today? And we're going to talk in some level of detail about Ray Dalio's MP3 theory and why our guest is an advocate of this sort of monetary policy. Now, if you enjoy this episode, make sure to check out our guest's website, richardduncaneconomics.com. We'll link to that in the show notes page. You can find access to hundreds of hours of high-level presentations, and you'll get it all for 50% discount if you input CFC as a discount code, as in cash flow connections. I do get a referral fee if you do input that discount code, but I'm telling you, I don't talk a lot about other people's educational products, but this is really worth your time if you're interested in this topic. And if you like this discussion, you'll find his content fascinating. Also, quick update here. We have now identified our second property for the ASIM Workforce Housing Fund, which is a 230-unit property in Albuquerque, New Mexico. I really like the Albuquerque market. The cost of labor there is very low. The taxes are very low and more predictable than some of the other markets out there. And because of that, and a variety of other factors, the expense ratios are some of the best in the U.S. So we're about to send out an email establishing the funding timeline for our investors and just confirming their investment amounts. So if you're still interested in investing in the fund, don't hesitate to go over to asimcapital.com. You'll see it clearly outlined, the ASIM Workforce Housing Fund. Happy to schedule a call to answer any questions you have. There's a lot of great content on the website. There's a webinar. There's a podcast with the sponsor. All of it is really helpful. All right. Hope you enjoy the episode. How's it going, everyone? Our guest for today is Richard Duncan, who is the author of 3 books on the global economic crisis, The Dollar Crisis, Causes, Consequences, Cures, which predicted the global economic disaster of 2008 with extraordinary accuracy and was also an international bestseller. His second book, The Corruption of Capitalism, a strategy to rebalance the global economy and restore sustainable growth, and his latest book, The New Depression, The Breakdown of the Paper Money Economy. Richard has worked as a financial sector specialist for the World Bank and has been a consultant for the IMF in Thailand during the Asia crisis. And he's also appeared frequently on CNBC, CNN, BBC, and Bloomberg Television, as well as a variety of other media outlets, conferences, and economic forums. Richard also was a guest previously on this program, which is episode 69, which we're going to link to in the show notes page. So, Richard, thanks again for coming on the program.
Thanks for having me back on.
Yeah, and we've also gotten a lot of feedback on this episode that we previously did. So if you're listening to this and this is the first time you've heard Richard speak, I definitely do suggest after hearing this one to jump back to episode 69. We're going to discuss some similar topics, but that was really comprehensive and a lot of the listeners enjoyed it. So speaking of that, last time you were on, end of November 2018, it's been about 9 months. There's been some significant changes in the overall economy. So let's start with that. So what, from a big picture, what has really taken place, since the last time that you've been on? What noteworthy changes in the economy have taken place that you're really keeping an eye on now?
Well, so the most important development has been that there has been a dramatic monetary policy U-turn since November last year. Back in November, the Fed was still telling the world that they intended to continue hiking interest rates on into the future indefinitely, and that they intended to continue destroying money through quantitative tightening for the next couple of years or more. But the stock market had a very significant downturn in December, And that forced the Fed to do this dramatic U-turn and announce that interest rates were on hold, they were going to be patient. And that brought about a rebound in the stock market. But then again, in May, the stock market started selling off. And this time the Fed said, okay, we surrender. We're going to start cutting rates and we're going to stop quantitative tightening in September, in fact. So that was a radical change in policy. And that contributed to the global collapse in interest rates and bond yields that has occurred since November. So that's been the main change. Interest rates around the world have plunged, and the Fed is now about to begin cutting interest rates. And for that matter, the European Central Bank has also announced that it intends to begin loosening its monetary policy even further and may resume quantitative easing sometime in the next few months.
Which is interesting because that was one of your main points of discussion last time, was the implications of the increasing of the interest rates and the potential for continuing quantitative tightening, which is a phrase that people aren't as familiar with. We're definitely going to talk about that. But even before we get into those details, offline, before we even started the conversation, you were talking about this paradigm shift that's taking place. And I think that's important to bring up now because of the fact that there can be this massive U-turn. Explain to the listeners what we were kind of discussing previously and why that ties in perfectly to this conversation about interest rates as well as, potentially gold, for example.
I think one of the most important things, perhaps the most important thing for anyone to understand about economics today, is that the economy doesn't work the way that it did in the past when most of the classical economic textbooks were written. What has changed is that 5 decades ago, the world stopped backing money with gold. In 1968, Congress changed the law, and up until that time, the Fed had been required to actually hold gold to back the dollars that it created. But in 1968, that requirement was eliminated by an act of Congress. And afterwards, dollars, and for that matter, all the other currencies in the world, ceased to be backed by gold or anything else. And this allowed an explosion of credit. It wasn't the only thing that resulted in this explosion of credit. There was another factor as well. In the past, to go back to the 1950s or before, banks were required to hold a significant amount of reserves against their customers' deposits, just so they would have enough cash in case there was a run on the bank. They could have enough liquidity reserves to meet the demands from their customers when they ask for their deposits back. So banks had a relatively high level of required reserves, liquidity reserves. The required reserve was quite a significant proportion of deposits. But over time, the Fed steadily, year after year after year after year, reduced the level of reserves that the banking system was required to hold. And the lower the level of reserves, that allowed the banking system to create more and more credit through fractional reserve banking. So by 2007, the banking system practically had no reserves whatsoever, which meant that they were free to create practically an infinite amount of credit. So between this breakdown of gold-backed money and the elimination of reserve requirements for the commercial banks, what we saw over the last 5 decades was a complete transformation of not only the US economy, but the global economy. Credit absolutely exploded. So, for example, from the end of World War II up until around 1980, the level of total debt in the country to GDP. What I mean by total debt is not just the government debt, but government debt, household sector debt, corporate debt, financial sector debt, all the debt. The ratio of debt to GDP was about 150% up until the early 80s. But after that, these changes that I've been discussing really kicked in and credit began to accelerate. And by 2007, the level of debt to GDP had risen from 150% up to 370%. And so as long as credit was expanding so rapidly, then consumers had more money. They could borrow more money and spend more money. Likewise, businesses could borrow and invest more. And the government itself borrowed much more and spent much more. And so all of this borrowing and spending drove economic growth. And growth in the U.S. pulled imports into the U.S., which allowed the rest of the world to export more to the U.S. So the global economy expanded on the back of this credit boom. I really believe that the economic growth dynamic completely changed. In the past, when dollars were backed by gold, the dynamic that drove economic growth was investment and savings, and more investment and more in savings. So businessmen would invest, some of them would make a profit, they would save that profit and then reinvest it. And that was the dynamic that made the economy grow. But that's not the way our system works anymore. There is a new growth dynamic. It is credit creation and consumption, and more credit creation and more consumption. And this has actually produced miracles. The global economy is much larger now than it would have been if we'd remained on a system where dollars were backed by gold. But the problem is, in 2007 and 8, we reached the point where the private sector had become so heavily indebted, they couldn't take on any more debt. And so at that point, this system, I call it creditism instead of capitalism, creditism started to collapse. And in order to prevent that from happening, the government jumped in and started borrowing very aggressively. Government debt since then has increased from, the debt held by the public has increased from $6 trillion to $18 trillion. So it's a $12 trillion increase in government debt. And on top of that, the central bank created $3.5 trillion from thin air and used that to help finance the expansion of government debt. And so credit did keep growing. And that was enough to keep the U.S. economy from collapsing into a Great Depression, the way it did in the early 1930s, when a similar process occurred. The credit couldn't be repaid then, and the banking system collapsed, and we had a 10-year Great Depression. This time that didn't happen because of the government intervention. But the private sector is still quite heavily indebted and can't afford to borrow enough to drive the economy. So what we've seen is that going back to 1950, anytime total credit in the US grows by less than 2%, total debt and total credit are two sides of the same coin. So if total debt grows by less than 2%, the economy goes into recession. That's happened 9 times since 1950. Now, this is total debt growth adjusted for inflation, to compare apples with apples. So you take the total debt grows by 10% and the inflation rate is 5%, then total debt adjusted for inflation would be 5% growth. Anytime that grows by less than 2%, the US has gone into recession. Since 2008, or really since 2010, when the recovery got underway, total credit has been growing just above 2%, but somewhere between 2 and 3% every year. And that's really not enough to bring about significant economic growth under this new system of ours, creditism. So what has been required, in addition to the credit growth, is asset price inflation. The Fed has more or less been forced to keep pushing asset prices, stock prices and property prices higher to create a wealth effect so that people will feel richer and actually be richer and have more money to spend. That boosts consumption, that boosts the economy, that boosts corporate profits, et cetera, et cetera. So for instance, the household sector net worth in the United States, that's the net wealth of the American public, all their assets minus all their debt, it hit $108 trillion in the third quarter of last year. That was up $49 trillion, or 82%, from the low in 2009, at the worst point in the crisis. So the wealth has almost doubled as a result of very low interest rates and quantitative easing. So what we've seen, what brought about this monetary U-turn back in December, was the stock market started falling. So in the fourth quarter of last year, because of the downturn in the stock market, net worth of the American public fell by nearly $4 trillion in that one quarter alone. And consequently, suddenly the Americans started feeling less rich and spending less money, and all the economic indicators started turning down in the US. And that's what forced the Fed's hand. The Fed cannot afford to allow asset prices to fall because credit growth is too weak to drive the economy. They need to have asset price inflation also to keep the economy out of recession. And so that's what's forced the Fed's hand. They've been forced to cut interest rates and reverse their stance on quantitative tightening, because if they didn't, the stock market was going to have a serious recession, the sell-off, and that would have caused a serious economic recession, not only in the US, but it would have spread around the world. So that's the background to what brought about this really very abrupt and almost shocking change in monetary policy.
So obviously, I mean, this is pretty significant, but give us an idea of how significant the quantitative tightening was. How many billions or trillions of dollars are we talking about in terms of actually removing money from circulation, just so the listeners can understand how far they got before this policy was reversed?
Okay, well, so the Fed began its operations in 1914. And between 1914 and 2007, they had created in total something just under $900 billion over the course of, let's say, a century. Then between 2008 and 2014, they created $3.5 trillion additional dollars. So the jump was from 900 billion to a total of about 4.5 trillion of total money that had been created by the Fed. Now, so that, of course, that caused the monetary base to increase at a rate that we'd never seen before, not even during World War I or World War II. And in theory, that should have caused very high rates of inflation. But in fact, it did not. And the reason it did not is because another important thing that has changed in the past 5 decades is that trade between countries now no longer balances. When we had a system where dollars and money, when money was backed by gold, trade between countries had to balance. Because if one country had a very large trade deficit, then it would have to pay for its trade deficit with its gold. It would have to send gold to the other country to pay for its trade deficit. And pretty soon, the deficit country would run out of gold, and they would have to stop buying things from other countries. So trade between countries used to balance when money was backed by gold. But after that ceased to be the case in 1968, and then especially after Bretton Woods broke down in 1971, then trade between countries no longer had to balance anymore. And by the early 80s, the United States government had realized this, and the U.S. started running very, very, very large trade deficits with the rest of the world. That's something that had never occurred before, on this scale at least. By 2006, the U.S. trade deficit was $800 billion that 1 year alone. That was 6% of GDP. So my point is, the reason that this explosion in the monetary base didn't cause inflation is because we no longer simply had a domestic U.S. economy subject to full employment and full capacity constraints as we had in the past. Now we had a global economy with, well, they say 2 billion people still live on less than $3 a day. So that we have essentially an infinite supply of low-cost labor. It's been extremely deflationary. So these deflationary forces of globalization prevented this mind-boggling surge in money creation from creating a significant amount of inflation in the United States, at least at the consumer price level. So that is how we've avoided having what people would have normally anticipated, a surge in inflation resulting from this explosion of money creation. But we haven't had that. So now, that's a rambling way. I'll try to come back to your question. How much was quantitative tightening? So the quantitative easing was the creation of new money by the Fed. The Fed created $3.5 trillion, and they used it to buy bonds issued or guaranteed by Fannie Mae and Freddie Mac. That pushed up those bond prices and pushed down bond yields on government bonds and also on mortgage-backed securities. And the lower interest rates, of course, benefited the economy in numerous ways by making credit more affordable and by pushing up home prices and making mortgage rates much cheaper, which benefited the property market and also the stock market. Now, so they stopped creating money and buying bonds in October 2014. And then when they felt the economy was strong enough, they started reversing this policy. In, I think it was the fourth quarter of 2017, they started what came to be known as quantitative tightening, the opposite of quantitative easing. With quantitative easing, they created money and bought bonds. With quantitative tightening, in effect, what they did was they sold bonds. And through the process of selling bonds, that destroyed money. So the amount of dollars that they have destroyed in this process is now approaching something like $700 billion. So the Fed's total assets peaked at $4.5 trillion around October 2014. Now they're down closer to $3.8 trillion since the Fed has destroyed $700 billion through quantitative tightening and reduced its bond portfolio by the same amount, roughly $700 billion.
And as you say, it's basically reversed the reversal now, and so things are kind of changing. How does this tie into the conversation about what most people are really concerned about, which is the inversion of the yield curve? Why is this an important conversation to be had, and how does that tie in to why the yield curve has, for many of the bonds between the 3 and the 10, for example, inverted?
So it's really quite interesting. You would expect that since the Fed has essentially sold off $700 billion worth of bonds, that by requiring other market participants to buy those bonds, that should have pushed interest rates higher. With the government selling so many bonds, the bond prices should have fallen and the interest rates should have risen. But that hasn't happened. And that's really quite alarming. Why have interest rates done, in fact, the opposite? Interest rates have plunged. What's the reason for that? Well, in part, one of the main reasons for that is the global economy has become very significantly weaker, in large part, although not entirely, but in large part due to the trade war between the US and China. So as everyone now knows, the US has imposed very large 25% tariffs on $300 billion worth of Chinese imports thus far. And that's having a significantly harmful impact on China's economy. China's economy was already in trouble even before the trade war started. China had an extraordinarily large economic bubble, and it was struggling to maintain its economic growth even before there was a trade war. But now with the trade war, China's economy has been driven by a strategy of export-led growth for decades, and it's worked fabulously. They've grown by exporting more and more goods, primarily to the US, year after year, and by investing very, very aggressively in fixed assets, factories and infrastructure. But now they've gotten to the point where they have so much excess capacity of everything, factories and for that matter, infrastructure, that it doesn't make any sense for them to continue investing. And the rest of the world has reached the point where the rest of the world is simply saturated with Chinese goods. They can't continue absorbing more and more Chinese goods year after year. So this was the situation even before the trade war started. Its growth model of export-led and investment-driven growth was already hitting a brick wall. And now, with the trade war, this makes it even more difficult for China to grow by export-led growth. So China's exports have been weak. And how does China respond to that? It responds by importing less from the rest of the world. When China exports less, it imports less. And so it's importing less not only from countries like Japan, Taiwan, and South Korea and its Asian neighbors, but it's also importing much less from countries like Germany and the other European countries, and of course the US as well. So this is hitting world trade, and it's caused a very significant slowdown in the global economy. Germany is verging on going into recession. And of course, Japan is always on the verge of recession. But now the rest of the Asian countries are weak as well. And so consequently, there are fewer viable investment opportunities in the world. With the global economy slowing, there are just not as many profitable opportunities as there were before. And consequently, there's less demand to borrow. And as a result of the less demand to borrow, interest rates are falling, since, of course, interest rates are the cost of renting money. If there's less demand for money, the price of renting money falls. And so we saw this very sharp drop in interest rates since we last spoke.
As you see this drop in interest rates, obviously everyone's concerned with and watching the yield curve as an indicator for recessions. I guess to put it in a way that I think the listeners will get the most out of, it's hard to see where the pain will come in this recession. The listeners of the show are very focused on real estate. There's a lot of metrics we use to track where we are in the cycle of real estate. It's easiest to track in the residential market. And looking at those main metrics, it's hard to say that we're currently in a state of mania. And if we're not currently in a state of mania, it's hard to see a reality where we have a drastic drop in prices because there's just not that much supply. There hasn't been this overdevelopment that you typically see, and the lending standards are very, very tight comparatively to, let's say, 10 years ago. Where do you anticipate, if there is a recession, who is going to feel it the most, and where are you seeing the mania that will cause that pain to be felt?
Well, I think I don't believe that we have any kind of mania on the scale that we saw back in 2006 and 2007. So I'm not that concerned that we're going to have that sort of horrific crash. Things are just not as overextended in most respects now as they were then. However, the most worrying indicator that I look at is something that I call the wealth to income ratio. What this is the net worth of the household sector, which, as I mentioned before, is about $108 trillion now. That's the net household sector net worth. If you divide that by disposable personal income, you get what I call the wealth to income ratio, because it's the amount of wealth divided by the income. Now, this is a data point that the Fed publishes, and the data is available back to World War II. Well, since 1950, the average of this wealth to income ratio has been 540%. Well, during the NASDAQ bubble, it went up to a new all-time high of 610%. And then that bubble popped and it went back to the average, 540. Then during the property bubble in 2006 and 7, the ratio went up to 666%. And then it popped and it went back to the average, 540. In the third quarter of last year, it hit a new all-time high that was significantly above the property bubble. It went to 690%. And so the first quarter was a little bit lower because we had a stock market sell-off back in December. But now the stock market's hit a new all-time high again. The most recent data for the second quarter hasn't been published yet, but it's likely to be a new all-time high, somewhere above 690%. So the wealth to income ratio is at an all-time high. That's telling us that asset prices are stretched. Now, why is this ratio significant and why can it only go so high? Well, the idea is that wealth can only go so high relative to income before the income is just not sufficiently large to allow individuals to continue buying assets and pushing up the value of assets. In other words, income needs to be high enough to allow the public to at least be able to service the interest on the money that they borrow to buy the assets. So that's why this wealth to income ratio is important, and it's never been higher than it is now.
That is interesting. I actually need a comment about that because as you were mentioning that, I was thinking it has to be something to do with debt, because just because you have a really big house and you have a small income doesn't matter. What really matters is that you've most likely used leverage to buy that house, or use another sector as an example, anything. The problem is servicing the debt. But again, I know you study a lot of metrics and real estate's not necessarily your main focus, but I'm surprised to hear that wealth ratio is so high, given that, again, the lending standards, at least in real estate, have been exceptionally tight comparatively to, what you mentioned, the property bubble, or even during the NASDAQ bubble. Is there any insight as to how that's being caused? Is it, obviously the corporate debt has been a big part of this conversation. Do you think that's the driving factor in that ratio being out of whack?
Well, the main factor is the stock prices have moved higher. So that's the largest component of wealth between people owning stocks outright and pension funds outright. But also property prices have moved higher, as you know, year after year, every year now going back to the crisis. So that has also added up over time, and property prices have moved up significantly. So here's where interest rates are so important. As we were saying, people have to have enough income to be able to afford to pay interest on the money that they borrow to buy the house or to invest in the stock market. And so if interest rates move higher, that makes it more likely that asset prices will fall. On the other hand, if interest rates move lower, then it makes it more affordable for people to be able to pay interest on the money that they've borrowed to buy these assets. And so that is why the Fed has been forced to begin cutting interest rates. They have to keep the asset prices up, and the only way they can do that is to make the interest rates go lower. And so I like to say the Fed is really a hostage to the stock market. it cannot afford to let the stock market fall, because if it does, we'll then have a very severe recession. And it wants to avoid that for as long as possible.
This is absolutely fascinating. And for the listeners that are interested in this topic, I'm sure as this is starting to tie together, as you started to mention interest rates, it all started to become very clear in terms of now, I've said it many times on the show that the Fed has basically backed themselves into a corner, but this really puts it into perspective. Wealth levels at all-time highs, debt levels near all-time highs. It really does come all down to interest rates. And so it's very challenging to see a way out of this without the Fed losing control, in the sense that they're incentivized to always keep interest rates low. And outside of something similar to what we saw in the 80s, where the Fed drastically reduced interest rates in the hopes that it would clear up some problems, I don't really think that that's going to take place in today's economic climate. Before we even go into too much detail on that topic, what do you think about that? I mean, there was a time at which the Fed raised interest rates drastically, and there was all the same political incentives were aligned at the same time as that took place, but they still did it. I mean, do you see that being a potential option as opposed to something else, like a permanent low interest rate environment similar to what Japan has experienced?
It seems very unlikely that they'll be able to increase interest rates significantly for the foreseeable future. But what is more likely is that rather than relying so heavily on monetary policy to keep the U.S. economy expanding and out of crisis, it's likely that we're going to see a greater shift toward more fiscal stimulus. So already the economy, the last year and a half or so, has already been benefiting quite significantly from a lot of fiscal stimulus. Roughly a year and a half ago, Congress cut taxes very sharply. And also in a separate bill, they increased government spending.
Right.
So that's a lot of fiscal stimulus came out of that. And that the economy has benefited from that without any question over the last year and a half or so. But that stimulus is now fading. So there's been a very fascinating debate recently between Ray Dalio, the legendary founder of Bridgewater,
sure,
and John Malden, who writes the newsletter Thoughts from the Front Line, which is one of the most widely read newspapers, financial newsletters in the world. And Ray Dalio said in an article that he made public on LinkedIn, he said, this is probably time for us to think seriously about modern monetary theory, and in particular, what he called MP3, Monetary Policy 3. Now, he explained what he means by MP3. Monetary Policy 1 was the traditional monetary policy, where the Fed would stimulate the economy by lowering interest rates. Well, you can only do that until interest rates hit zero, and afterwards you can't lower them any further. So that forced the Fed to move toward Monetary Policy 2 when they got to 0% interest rates. And Monetary Policy 2 was quantitative easing, printing money and buying bonds. But the problem with that is eventually that causes a lot of problems. It causes asset price inflation and growing income inequality. And it doesn't necessarily get into the hands of the normal people who would spend the money and stimulate the economy. So its potential to stimulate the economy eventually ends as well. Therefore, he's coined this term, Monetary Policy 3, MP3, to suggest that in the next economic downturn, the best alternative that we will have available to us is a combination of coordinated fiscal stimulus financed with quantitative easing. In other words, governments will have much larger budget deficits, and the Fed will finance these budget deficits by creating money. And it will be a coordinated policy. How it will be coordinated is yet to be determined, but the government, in essence, will be spending much more, larger budget deficits, and it will be financed by quantitative easing. So he didn't say he relished this idea. He simply pointed out that this will be the best alternative available to us in the next economic downturn, and it's very likely to be the thing that happens. Therefore, we need to begin thinking about it. Investors need to be thinking about its consequences, and also, as a society, we need to think about how this should best be structured so that it will generate the most economic growth for the greatest number of people. Now, John Malden, for whom I had tremendous respect, replied in his Thoughts from the Front Line newsletter, which they say has millions of readers, subscribers. He replied in a 6-part response, which was called something like Ray Dalio is sort of kind of really wrong about MP3. And so week after week after week for 6 weeks, I read his response. And in the end, what he ended up advocating was he identified the government budget deficit as the biggest threat facing our society. And he said it can't go on forever. And the sooner we take the medicine, the better. And in the end, what he ended up proposing, as I understand from reading his article, was that we introduce a value-added tax large enough to make the budget deficit go away. Well, so this is an enormously important debate because on the one hand, the value-added tax large enough to make the budget deficit go away. The budget deficit last year was nearly $800 billion. So if you introduce an $800 billion of additional taxes, that's going to mean the American public will have $800 billion less to spend on consumption. And that will cause an extraordinarily severe recession. Corporate profits would crash, so businesses would have much less profits, and they would have much higher inventories, so they would stop investing, and they would start firing workers. So unemployment would go up, so consumers would have even less than $800 billion to spend because they'd be unemployed. And that wouldn't even balance the government's budget because in the severe recession that would follow, of course, the stock market would fall sharply because corporate profits would be falling. So what you would see is the government income, the tax receipts would plunge because capital gains taxes would go away. Capital receipts from capital gains would go away. And also fewer people would be employed. So there'd be less income tax received by the government. And at the same time, with more people unemployed, the government would have to spend more. So the spending would increase, its tax receipts would drop, and the budget deficit would be larger than $800 billion last year in this case. So you'd have to have even more value-added tax to try to balance the budget. So it would have resulted in an extraordinary downward spiral that would replicate the Great Depression. Now, so I'm entirely opposed to that idea. For me, that's the economic equivalent of the medieval medical practice of bleeding sick patients to try to cure them. It's the economic equivalent of bloodletting, which killed more patients than it cured. We do not need that. MP3, on the other hand, does offer some extraordinary possibilities. For instance, if the government is going to spend more, then we need to think about what it's going to spend the money on. And because we live in this different environment now, where, as we've seen over the last 10 years, the government has increased its debt by $12 trillion, and the Fed has financed roughly a quarter of that by creating money, and it hasn't caused any inflation at the CPI level. So that is a fact. That is what we have experienced. And so it suggests that we could do more of the same, more government spending to stimulate the economy. Now, whether or not this is sustainable over the long run depends on how the money the government borrows is used. If it's used just for paying for consumption or invading some foreign country, then it's just all going to be wasted. On the other hand, if the government borrows and invests in new industries and new technologies, the way China does, for instance, on a very aggressive scale, then it could produce extraordinary breakthroughs in all kinds of fields, including medicine. We could potentially cure many of the world's killer diseases. I like to read a lot of history. 200 years ago, every year, thousands and 10,000s of people in all the major cities of the world would die of smallpox and cholera and other diseases. But we cured all those diseases. Now we have the chance for the government to borrow and invest and have the Fed finance this with paper money creation. In other words, what Ray Dalio believes is inevitable, MP3, monetary policy 3. If we structure this in the right way, we could invest so aggressively in new industries and technologies, things like genetic engineering, biotech, but others as well, neurosciences, artificial intelligence, green energy, robotics, and on. We could induce a new technological revolution that would not only keep our economy from collapsing into a new depression, but would result in breakthroughs, medical breakthroughs, technological breakthroughs that would improve the well-being of everyone on this planet. And so that is the choice in this great debate between, I call it the debate MP3 versus VAT. For me, VAT is death. MP3 offers the potential to extend our lifespan for years, if not decades, and cure many of the most intractable problems we face. So I've been really quite interested in, if not obsessed, by this great debate, MP3 versus VAT, Dalio versus Malden.
Fascinating. And this is the first time I've talked about this on the show. So it's definitely a resource that I think people should be paying attention to. And also in this conversation, I think it's important to discuss kind of the distinction. And I think Ray Dalio does a good job of kind of the distinction between what he thinks should happen, what will happen, and what has happened. I mean, to me, when I start to hear about the idea that government will bring about a revolution in terms of medical devices, I mean, it's hard for me to overcome, and maybe I have some confusion on this, but for number one, I certainly don't have a confusion on the way that government tends to spend money. And the idea that a lack of oversight is to blame for this historically is hard for me to grasp, given the amount of checks and balances that we so-called have, the amount of regulations, the amount of regulatory hurdles there are, and especially in things like the financial and medical sector. I would be much more a proponent of the relaxation of those regulations to bring about this medical revolution. You know, there's these articles about the Pentagon, for example, having these $700 toilet seats and stuff. I would anticipate there would just be more and more of that as opposed to invention. What are your thoughts on that? Obviously, this is the first time someone's asked you that question, but what is your response to that regarding, historical overspending and really a malinvestment on the part of government?
Well, I think there's been a lot of discussion about the malinvestment and perhaps not enough recognition of what the government investment has accomplished. I'm sure you have a smartphone in your pocket. Well, almost everything in that phone that makes it smart was the result of government investment, starting with semiconductors and followed by things like GPS, touchscreen technology, and of course the internet itself. They were all products that resulted from government investment. But your point is, of course, valid as well, in that there can be misallocation or misuse of money. Therefore, we could structure this government investment as cooperation between the government sector and the private sector. Let's say, just for instance, what we've seen over the last 10 years is the government's debt has increased by $12 trillion. So we're talking about trillions of dollars. I believe, and I have recently made a macro watch video showing that the government could invest an additional $8 trillion on top of what it's expected to spend already over the next 10 years without having a significantly damaging impact on the level of government debt. Now, how I would propose government do this, the government could form joint ventures, companies, with the 10,000 most promising American entrepreneurs, and set up joint venture companies with them, with the government keeping a 60% equity stake in exchange for providing the capital, lavish amounts of capital. And the entrepreneurs would keep a 40% equity stake in exchange for managing the companies. So you would have the private sector managing the companies and the government funding these joint venture companies. Now, with this kind of money available, some of these joint venture companies would make extraordinary breakthroughs. We're talking about the most talented American entrepreneurs working with the most talented American scientists with limitless amounts of money to invest in new industries and technologies. Well, when one of these companies begins inventing cures for, let's say, diabetes or cancer or Alzheimer's, that company could be listed on NASDAQ at extraordinary valuations that would pay for, these things would pay for themselves many times over. So it would have the valuation of companies like that on NASDAQ would be extraordinarily high. And the US taxpayer would keep 60% of the profits because they own 60% of the company. And so these kind of ventures would pay for themselves many times over. So rather than causing the government debt to increase, it would actually reduce the government debt, make the economy grow at a much more rapid rate than it has grown in recent decades, and as a byproduct, result in technological breakthroughs and medical marvels that improve the well-being of everyone on this planet. So that's how it could be done.
Interesting. So one thing I want to circle back on, this is the thing that I could have some confusion about, so hopefully you'll clarify this. So you mentioned Japan, and we did talk about this briefly last time, and I want to keep it short because I do want to stay within the time period. I want to do an entire episode on this topic with you particularly because this is a topic I'm fascinated by. But you mentioned during the discussion that Japan is constantly on the verge of recession. Even though their strategy is not exactly like yours in terms of investment, from my perspective, a similar strategy regarding government intervention in the economy is the cause of them constantly being on the verge of recession. So they experienced about an 80% asset price correction, and since then they've been doing quantitative easing infinity. Now, that money may not be directed in the exact same way that you would intend, but the point is it's a controlled economy and they're implementing billions of dollars into the economy. My understanding is a big reason that they have not been able to overcome this constant 20-year recession is due to the burden of debt and the fact that they must constantly purchase their own bonds to infinity. And it's having an impact on the culture as well as the demographics. What are your thoughts on that? And I know this is a topic that you're fascinated by. So again, I do want to have you on just to talk about this one topic, but within a 3-minute characterization, what are your thoughts on how the government action in Japan has played a role in them being in this perpetual situation on the verge of recession?
Okay, well, so first of all, Japan's population is shrinking. So the number of people in Japan is shrinking. So when you have a shrinking population, there's only so much your economy can grow by.
Yes, but I guess my perspective, I could be wrong about this, but my perspective is there's a reason for that, which has something to do with the culture, which is changing due to the debt burdens. Is that?
Well, no, I would disagree with that entirely. The Japanese demographics have been slowing. It's been a multi-decade process. I mean, it's been going on. I don't think it has anything to do with quantitative easing in Japan. Now, I first moved to Asia in 1986. And at that time, people believed that Japan was going to become the largest economy in the world and Godzilla economy was going to take over the world. And all the buildings in Hong Kong where I lived, they were being bought up by Japanese corporations and renamed Japanese names. But Japan had an extraordinary economic bubble. As you know, the stock market was trading up and the property was so inflated that the gardens around the Imperial Palace in Tokyo were more valuable than California. So we're talking about a bubble beyond anything that we'd ever seen before. And it popped. And rather than having a Great Depression, the way that the United States did in the 1930s, that lasted for 10 years and only ended when we had massive government spending on World War II, financed with paper money creation. It didn't end of itself. It ended because we had massive government budget deficits financed with massive amounts of paper money creation by the Fed. That ended the Great Depression. So rather than going through this 10-year period of Great Depression with 25% unemployment, instead they just opted to go ahead and spend the money to start with, have the government deficits to avoid the depression. So I don't know if you've been to Japan recently, but the people in Japan have quite a nice lifestyle. It's not like Japan is impoverished.
Agreed.
They live until their 80s and beyond. You go to the hotel, you go to the gym, it's full of 80-year-olds with trainers. So they have avoided having a Great Depression because they have had large government budget deficits financed with paper money creation. So this is an example of what is possible. Japan, when their crisis started in 1990, their government debt to GDP was 60% of GDP. Now it's 240%. And has this caused the Japanese government to go bankrupt? No. The Japanese central bank has created enough money that it now owns 40% of all Japanese government debt. And the Japanese government can borrow money for 10 years at not only 0%, they actually borrow money and get paid to borrow. The yield on a 10-year Japanese government bond is minus 15 basis points. So there has not been a fiscal crisis in Japan. And 240% government debt to GDP. Well, U.S. government debt to GDP is only 106%. So this suggests the U.S. GDP is $20 trillion. So this would suggest that the U.S. government could borrow another $20 trillion, let's say over the next 10 years, before it even hit 200% government debt to GDP. And of course, that's assuming that the economy didn't grow at all. Whereas if the government borrowed and invested that kind of money, the GDP would grow by 10% every year, and we would never get to 200% government debt to GDP.
Yeah, it's a fascinating conversation. And again, I know that this is something that you take very seriously. And it's something that I've been fascinated by because I still have some disconnect in terms of understanding. Because you're right, I have been to Japan and I've been to Tokyo in particular, and it's pretty much unlike anywhere I've ever been, to be honest. But more than that, it's hard to reconcile the lack of economic growth with the clear high lifestyle that many Japanese people have. So again, I do want to cut that off there because I do want to have, I'm just so fascinated by this conversation. We should definitely do it in a more formal discussion. But, before we let the listeners know, and I'll definitely mention this at the beginning because I think your program is absolutely amazing. Tell the listeners how they can learn more about you and your work and your website and your books as well.
Well, thanks. Well, let me just pop up that conversation by saying I think Ray Dalio puts it very well. He's more or less saying that we find ourselves in the position we are. It may be unfortunate that we are in a position where interest rates are approaching zero and quantitative easing is also losing its efficacy. But given where we are, it's very likely that what we are going to see is this transition toward MP3, the combination of higher budget deficits with quantitative easing. So like it or hate it, it's important to be aware of it. And if this is going to happen, we need to think carefully about how we're going to spend the additional government money. If we spend it wastefully, then it's unsustainable and it will ultimately end in disaster. But if we have this opportunity to spend all this money, as Japan's experience suggests that we do, then let's invest it. At least this is, and he also advocates more spending on infrastructure and education and research and development, which is so crucial. Then yes, we as a society, we need to have this conversation and make sure that the money goes toward investment and research and development rather than taking over another country in the Middle East somewhere, which would just have disastrous consequences.
Of course. And that's a
fact.
That's been
it's
proven.
Important to think this through. So that's, again, why I've been so fascinated with this great debate, MP3 versus VAT. Okay, so thank you. My business, which is Macro Watch. I publish a video newsletter called Macro Watch. Every couple of weeks, I upload a new video. Essentially, it's me making a PowerPoint presentation discussing something important going on in the global economy and how it's likely to impact asset prices. And I really try to explain to Macro Watch subscribers how the economy really works now, because it's not the way that it used to work back when money was backed by gold. So it's important to understand how the economy works now. So subscribers to Macro Watch will receive one new video every couple of weeks, and they will have immediate access to the 50 hours of Macro Watch videos in the archives, including 4 different courses. One being how the economy really works. And another important one that I'm particularly proud of is a course on monetary policy, how monetary policy works today. So I would like to offer your subscribers a 50% discount if they will visit my website, which they can find at richardduncaneconomics.com. That's richardduncaneconomics.com. Hit the subscribe button, and when prompted, if they use the discount coupon code CFC, that's CFC, they can subscribe at a 50% discount. So I hope they'll check that out. And at the very least, sign up for my free blog.
Absolutely. And, I could say, listeners of this program, if you enjoyed this conversation, there is a wealth of information. You'll be incredibly impressed by the depth of knowledge across a variety of topics. And we've only scratched the surface today, and I look forward to many more conversations in the future. Richard, I really can't thank you enough. I appreciate it.
Well, Andres, it's a pleasure talking with you, and I look forward to the next time we talk.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.